Welcome, I'm Ernie Goss, Professor of Economics here at Creighton University in beautiful downtown Omaha, Nebraska. Here I am on the first business day of the month to report on our findings for the 9-state region. And we've been doing this for 20 years, more than 20 years. And we're talking about the region that's North Dakota and Minnesota in the north, to Oklahoma and Arkansas in the south, the 9 states there in that region. Now, what we have is what we call the Business Conditions Index, and that index spans from 0 to 100. Anything of 50 and above 50 is growth positive. Below 50 is growth negative, okay? Now, 50 is right on, that's growth neutral. And this is sort of like the canary in the coal mine. I remember when the miners used to take the canary down the coal mines to tell if there was any deadly gas in the coal mine. Well, that's the same thing here, except we're not looking for deadly gas. These purchasing managers, supply managers are looking for an economic downturn. They're not seeing it, not seeing it yet. Things are a little soft, and we know that. Looking ahead, the overall index for the month, it was down a bit. It was moved from 57 last month, that was February, to 51.4 this month. Getting close to growth neutral, folks, so that's not a good thing, moving in the wrong direction. I think the national number that comes out later on this morning will likewise be softer, and that's something we need to be a little concerned about, but don't get overly concerned. The numbers are pretty good. Positive hiring, the number moved from 50.8 to 52.5. That's moving in the right direction, not a strong index. We ask about how many applicants you have for every job opening across the 9-state region, about 5 applicants for every 3 jobs. Now that's about what we've been seeing. You may think that's not good. Well, it's pretty good. We just advertised for a job here at Creighton for an economist. We had one opening. We had 290, no, it was about 260 to 70 applicants. So if you think that's tough, get you a PhD in economics and go looking for a job at Creighton University. It's some tough competition. But anyway, enough of crying from me. Also, we ask about the average entry-level job for a college graduate, $45,500. That's about what I expected. That's about what we're seeing from our graduates here at Creighton, although it depends on the degree. Some of them are much more than that. I would say that's about an average number, $45,500 for an entry-level college job. Now here, let me show you the index comparing the two that would be the U.S. Purchasing Management Index and the U.S. Purchasing Management Index from October 2013 to March 2015. That's the one we just recorded. Now look at that. You see in red is the U.S. Now the number has not come out for the month of March. Ours has come out, and as you see, it's dipped down there, but still you see both above growth neutral. Look, it's been a long time, October 2013, since we had one at growth neutral. So you see, it's not so bad. We're seeing now that's hardly makes you jump up and down when an economist says it's not so bad, but that's all we can do, folks. This economy has been limping along since 2009. That would be when we moved out of the recession. It's been growing at 2%, 2 to 2.25%. Should be growing at twice that. I only talk about the economy. I don't have much to do with it, unfortunately. I don't pass legislation. They do. I don't set interest rates. They do. Low inflationary pressures from our survey. The index moved from 51.5 to 55.7. Now that's moving upward, but still, folks, don't get excited about that. That's inflation, not much. I'll call that muted inflationary pressures. Don't think inflation's ticking up anything significant to the point you should be concerned. Confidence moved from 58.4 to 55.7. Again, not so much there. Now here's the surprising part. Export orders up from 54.4 to 56.4. What's going on there? I don't know. This is very hard to understand because the dollar has been increasing in value, making goods from this part of the country, and for that matter the rest of the nation, less competitive abroad. Our exports should be coming down. They're growing. That's a good thing for growth, but it's just hard to explain. Maybe there's something going on with our survey. Maybe there's something going on there with the national statistics that we're seeing. Okay, that sort of wraps it up for the survey. Now, again, it's pointing to slow but positive growth in the next 3 to 6 months. Inflationary pressures muted, job gains okay, nothing to jump up and down about. Okay, but what are some things you need to keep an eye on going forward? Jobs report this Friday, April the 3rd, first Friday of the month. The number of jobs added probably is going to be 200,000 and above. That's a pretty good number. The problem is the mix of those jobs is the real key. And what you're seeing is the wage number, because of those mix of jobs, is just not as strong as we'd like to see. And not much upward pressure on wages. But if there should be, now how would you know? Well, if the year-over-year wage growth goes above 2%, headed on the way to 3%, then you need to get ready for a rate hike. Rate hikes faster, that's interest rate hikes faster than you're now expecting. I mean, I'm expecting. I think the number is going to be around 2%, which means the Federal Reserve is on track to raise rates probably June or July of this year, but it's going to be a small rate hike. It's going to be on the short end, not the long end. So, on the Q1 GDP number, that's the next number I'd like for you to watch out for from the Bureau of Economic Analysis. Comes out April the 29th, and you're asking, well, that's the Q1. We've already finished it. Why would you be concerned? Why should we watch it? Because it's telling us about this economy, where it's going, where it's been, and likely where it's going. And where it's going is growth between 2 and 2.5%. Only an economist could love this kind of growth, because this puts us in high demand because everyone wants us to explain to you why it's going on. This is, only an economist could love growth at this level. We need to see growth twice what we're currently seeing. Twice. Instead of 2 to 2.25%, we need to see something like 4 to 4.5 to even to 5% growth at this term in the business cycle. We should be seeing that. We're not seeing it. And if we did see it, though, interest rates would be headed much higher, much more quickly. Risk. What are the risks I think you need to be keeping an eye on? Long-term interest rates. Those rates reflect inflation, which, as I said, is muted, not likely to go much higher. Also reflects investors taking their money out of the U.S. When they take their money out of the U.S., they're no longer willing to lend to us as readily. Then rates head higher. Also risk. As risks sort of move lower, then those yields will move higher, believe it or not, as investors move to more riskier bets. And a riskier bet, maybe you'll buy a Greek bond. That's a riskier bet. We'll see. I wouldn't encourage that. Too early to buy a Greek bond. Do not, in fact. You might want to buy a Spanish bond, an Italian bond. Don't buy a German. You don't get enough rate of return there. It's 0.5% to 1%. So buy one of those Spanish bonds. Even those rates are not high enough to compensate, in my judgment. I'd buy some bonds from some other nation where I could get a higher rate of return. Another factor to keep an eye on, of course, is Russia and Ukraine. And goodness knows that Mr. Putin, if you can predict his actions, you're a better person than I am, and a better person than almost anybody else. Nobody can predict it, even his former spouse. So keep an eye on that. Oil prices moving lower. It's good for the consumer, good for you, good for me, but not necessarily good for some businesses. That a lot of investment that was going into energy is not going there. In other words, building a new drilling rigs? No. Why would you build new rigs with oil prices moving to $40 and maybe headed to $30 a barrel? Not yet, but it could be. The indications are we're probably going to see lower oil prices. That's a little bit of a risk factor. Now, the positive side, overall it's good for the economy though, so don't get too concerned about oil prices moving in that direction. Just be concerned about certain sectors. Well, that's it. That's our report for the month of March. Here I am on the first business day of the month, as I've been for many, many months and many, many years, talking to you about the economy. And again, it was a good report. It could be better, and it will get better. I'm confident. It's just taking a long time to crawl out of this hole we've been in for some time now. So until we meet again on the first business day of May, I'm Ernie Goss, Professor of Economics here at Creighton University in beautiful downtown Omaha, Nebraska, wishing you good economic returns, and may your economic cup runneth over. Thank you.